Our mission today is really laser focused. We're diving into a whole stack of analysis on one company, Sofi Technologies.
Right.
And for a stock like this, it lives in the fast lane of fintech. It generates this relentless, just overwhelming tide of daily data. It's so easy to get paralyzed by all that
It
noise.
is.
So we're here to extract the key actionable insights. We're going to separate that foundational long-term signal from all the minute-by-minute drama so you can walk away with some real clarity.
And that's the critical distinction. Our sources today are brilliant because they don't just give you a snapshot. They offer a panoramic view. They frame the recent performance within two huge interconnected themes.
Okay, what are they?
So first, you've got the crucial external forces, the macro drivers. We're talking primarily about the rapidly evolving landscape of expected Fed rate cuts.
Big picture.
Exactly. And second, we have the internal market mechanics. So the technical and the institutional signals that show us exactly where the biggest players are placing their bets.
And we had a perfect example of that chaos just recently, didn't we? The stock closed up, what was it, 2.94%?
Yeah, just under 3%. On pretty healthy volume, too, around 44 million shares.
Which, on its face, sounds like a good, solid day.
A great day. But if you were watching the pre-market action...
Oh, it was a disaster.
Yeah.
Our source material described the mood as feeling like Armageddon was coming. It dropped hard and then just snapped back, a major reversal.
A huge reversal.
Okay, let's unpack that. What on earth changed in the external environment to spark such an immediate, dramatic recovery?
It was almost entirely the market reacting to a fresh wave of external economic data. And this data wasn't like spectacularly good news in a vacuum.
Right.
But it was precisely what the market needed to hear to confirm its belief that the Federal Reserve is indeed on a path to easing interest rates, probably sooner rather than later.
So it just gave them the justification they were looking for.
Exactly. The justification for that bullish long-term thesis.
Okay, so let's get specific about those numbers, because that's what the story is. The sources pointed to the updated ADP employment figures and the latest payrolls.
They noted that October was a little bit blah, I think was the word you used.
Right, sluggish.
Yeah,
But November came in stronger than a lot of people were forecasting.
it did. And then you have the third point. Retail sales were slightly below expectations.
And this is where you have to flip the script on what counts as good news. Right?
Yeah, this is the moment. For a long time, strong data meant, hey, the economy's resilient. Now, the market sees slightly weak data like retail sales missing the mark as fantastic news,
Especially for a company like Sofi.
especially for a high-growth lender like Sofi.
So explain that. Why does a slowing consumer actually help a digital bank?
Because it's the definitive proof that the economy isn't, overheating. If spending was just surging, the Fed would be forced to keep interest rates painfully high to fight inflation.
Okay, got it.
So slightly weaker retail sales suggest the current monetary policy is working, it's doing its job, and that gives the Fed the cover it needs to move forward with the rate cuts everyone is waiting for.
And for a company like Sofi, lower rates are like a massive tailwind.
A massive tailwind on two fronts. One, it lowers the cost of capital for all their lending activities. And two, it widens their net interest margin, their MM.
And connecting this to the bigger picture, the source material identifies this potential for falling rates as the single biggest catalyst for the company.
It's everything. It's not about their next product launch or some new feature. It's about the fundamental cost of money itself.
It's the foundation.
The whole foundation. The market is betting on a prolonged downward trend in rates,
Right.
ending this high-rate regime that has just crushed profitability across the entire lending sector.
And when that happens,
When that happens, a digitally native, cost-efficient company like Sofi One that doesn't have the overhead of, thousands of brick-and-mortar branches is structurally set up to benefit way more than the traditional banks.
so that long-term belief is what underpins everything, no matter how wild the daily swings get.
That's the bullish outlook, yes.
Okay, so that sets this powerful macroeconomic stage. The long-term gravity is pulling towards lower rates. But let's zoom in. What are the immediate forces, like the short sellers, the technical hurdles that are trying to fight that vision? This is where it gets tactical.
It does, and that's where we have to look at the short interest data. The source noted that shorts recently increased their position, but only slightly. It was about 68,000 shares.
So basically just daily noise.
Just noise. The real takeaway is the total size of the bet against Sofi. It's 9.2% of the free float.
And what does that mean in terms of actual shares?
It means 114.2 million shares have been sold short. Shares that eventually have to be bought back, they have to be covered.
Okay, 114 million shares sounds like a massive powder keg. But if the daily volume is 40 or 50 million shares, couldn't they cover that pretty easily? The days to cover metric, the DTC, was what, 1.64 days?
Yeah, quite fast.
So why should anyone worry about a squeeze if, technically, the shorts can get out in less than 2 trading days? I want to understand why the source calls them rather overextended.
That is a great, critical question. The DTC is a theoretical number. It's based on average volume.
Right.
The implication in the source's warning is all about mechanical risk. Think about it. When a short seller covers, they become a buyer. If 114 million shares suddenly rush for the exits because of good news or a technical breakout,
The volume would explode.
it would explode, and the buying pressure itself would send the price skyrocketing because there just aren't enough willing sellers at the current price. It creates this self-reinforcing upward spiral, even if the math on paper says they can cover in 2 days.
So the position is large enough to create a massive market inefficiency if momentum really shifts.
Decisively, yes.
That puts the potential energy in perspective. Okay, so alongside that mechanical risk, we can look at options flow to see what the street is thinking right now. What did the source say about the immediate consensus?
Well, the sentiment was definitely leaning bullish, but more importantly, it was highly targeted. 47% of the flow was bullish.
Okay, so just under half.
But there was a clear consensus forming around a specific target price range, $27 to $27.50. This isn't just random optimism. It shows the derivatives traders are actively putting capital on the line, betting the stock will hit that specific range, and soon.
A $27 and $27.50 options target is pretty aggressive. Let's talk pure technicals. What are the specific levels that have to be breached for that to happen? Where did we close, and what are the boundaries?
So the stock closed a little below where we want it to be at $26.58. Technically, that puts it right between the pivot point and the first support level, or S1.
And where is that first key support?
The source identifies the strongest immediate support at $26.48. Holding that line is really crucial for stability.
And if it breaks?
If the price slips below that, the next foundational support is down at $26.09. These are the levels where you'd expect institutional buyers to be waiting to step in and, absorb any selling pressure.
Okay, so that's the floor. What about the upside? What are the immediate ceilings the bulls need to punch through to get to the $27.50 target?
The resistance points. The first major hurdle identified is $27.10. Breaching that would likely trigger a lot of follow-through buying.
And if they clear that?
If that level holds, the next critical test is up at $27.72. These resistance points show us where people who bought higher before might be waiting to sell and just get their money back, which creates some temporary supply.
But the source really stressed that the entire technical picture, all of it, revolves around one single number, a number that acts as the psychological tipping point for confirming that full recovery.
Absolutely. It's the 100-day moving average. And it was sitting precisely at $26.64.
And that's not just some line on a chart.
No, not at all. It's a standard technical indicator that institutional algorithms and fund managers rely on. The source was very clear. Closing above $26.64 is the required action to confirm that momentum has truly shifted back to the buyers.
So until that happens, the recovery isn't really complete no matter how good the macro news feels.
It's technically incomplete. It validates the trade.
So we have the macro winds shifting in their favor and this really clear technical fight playing out. Let's shift gears a bit, away from the trading noise to the underlying business strategy. It's easy to get lost in the numbers, but what is the company actually doing to build its brand for the long term?
Well, what's fascinating here is a small, but I think strategically significant initiative. They launched a new podcast.
A podcast?
Yeah, it's called Culture and Capital, and it's developed with an agency called Cashmere. The show's focus is explicitly on early-stage investing and wealth building.
Okay, but a podcast doesn't generate immediate revenue. The source even pointed out it's not a massive catalyst for buying shares today. So what's the strategic value there? Why do it?
It's all about customer acquisition cost and brand affinity. This signals a really sophisticated effort to expand their brand beyond just, core financial products.
They're moving into content.
They're leaning directly into the creator economy and the bigger conversation around future wealth creation. They're targeting a demographic that's interested in building capital, not just borrowing it.
So if they can build trust through content,
then they lower the friction and the cost of acquiring high net worth users down the line. users who might eventually use their entire suite of services, from banking all the way to investing.
So it's a soft marketing touch that actually complements the technical resilience we were just talking about.
Yeah.
And speaking of resilience, the source material made a point to highlight the beauty of the stock's tendency for V-shaped recoveries.
Yes. That phrase V-shaped recovery is key. A lot of other high-growth stocks might, drop like a rock after a rough session and then just stay down.
Languish for weeks.
Exactly. But this stock consistently shows an ability to just snap back very quickly.
But hold on, if the source is pointing out V-shaped recoveries, doesn't that inherently mean the stock is facing these brutal, sustained sell-offs in the first place? I mean, that extreme volatility is a massive risk factor itself.
It absolutely is. It highlights the inherent volatility of the sector they're in. But the analysis then pivots to why those recoveries happen so reliably. And the answer is pretty clear. Institutional confidence.
So volatility just creates an opportunity for the big players.
For those with conviction and deep pockets, yes. When the retail market is panicking and selling off hard, the institutions are just stepping in to accumulate.
And we have actual proof of that, right? The source cited a specific, massive buy order.
We do. The source detailed significant institutional buying on the dips. Specifically, we saw one recent major institutional purchase, a massive block trade of 40 million shares.
Executed in a single order.
One single order. This isn't just a big trade, it signals high conviction. These block trades, they're often done off exchange to avoid spiking the price while they build a position. It just confirms that the big players are still very much in the game.
They're using that volatility as a mechanism to load up quietly. So let's synthesize these three layers for the listener. We have the powerful macro optimism, we have clear technical levels to watch, and we have this confirmed institutional faith. What's the core lesson here for someone dealing with that kind of crazy volatility?
I think the source material offers some really profound advice here that goes beyond just price targets. It addresses investor psychology. It clearly states the futility, the stress of tracking every daily move minute by minute.
You'll give yourself gray hairs, as they put it.
You absolutely will. It's just financial anxiety waiting to happen.
And there was a specific warning about using leverage, about being on margin during those chaotic dips.
Precisely. The source warns that if you're heavy on margin, if you're trading with borrowed money, these brutal temporary sell-offs can just wipe you out. They can force you to liquidate at the absolute worst possible time, even if your long-term thesis is still perfectly intact.
So the successful strategy they laid out is basically the philosophical opposite of trying to time the market.
It is. It's all about methodical long-term accumulation.
Dollar cost averaging.
Exactly. The source notes that those who have been dollar cost averaging systematically buying over time, especially since the $10 range or throughout 2023 and 2024, they're described as laughing right now.
Because they're not worried about the daily noise.
They are completely unconcerned. Their cost basis is solid, and they have faith in that long-term trajectory that is now being confirmed by the shifting macro environment. Their success is a testament to consistency over timing.
That strong advice really leads us to the final, comprehensive conclusion drawn from all our source material today.
And that conclusion is incredibly bullish, but it's also grounded. Sofi is identified as a solid, all-around stock with a massive future ahead of it. This whole outlook is reinforced by the dual tailwinds of interest rates trending downward.
Improving their core business.
And continuously strengthening fundamentals. And it's all supported by that confirmed, sustained institutional presence that just sees these dips as buying opportunities.
This was a genuine deep dive into the momentum, the technicals, and the critical macro environment shaping this company's future. To recap for everyone, the macro catalyst is definitively that rate cut expectation. The institutional support is confirmed by those huge 40 million share block buys, and the immediate short-term signal to watch is a close above that 100-day moving average at $26.64.
Right. And this raises a powerful question for you to continue exploring as you watch this all play out. We established that institutional investors are using dips to accumulate massive positions. We saw that one 40 million share block buy, while the total short interest remains stubbornly high at over 114 million shares.
An imbalance of conviction.
A huge imbalance. So given that confluence of strengthening fundamentals and sustained institutional buying pressure, how does that impact the likelihood of the 100-day moving average being decisively crossed? And maybe more importantly, what might happen next if that massive short position remains rather overextended during a confirmed technical breakout? That mechanical pressure, that's the fight to watch this week.
A great question that links the technical fight directly back to that institutional conviction. Thank you for joining us for the deep dive. We hope this information helped you cut through the chaos, navigate the volatility, and stay ahead of the curve. Until next time.